An email here from Bill in Winnipeg. It's on Nike. Besides the technicals, he asks, can I have your opinion of this company?
So look, this is a great branded consumer products company. You have to think about the fact that here we are headed into World Cup, and the stock is somewhat underperforming. They obviously have a huge opportunity when you have World Cup and you've got all the coverage. But the only problem I see is that in general, consumer discretionary is lagging a little bit from a sectoral perspective. Nike has lots of opportunity around the world to grow. They've got a real push on in fitness-oriented electronics, which is a positive. But it's just a sector that we're not so focused on right now. I think that it's not one of the leading groups. And Nike right now is not behaving as one of the strongest companies within the group. So it's not a top pick. It's a great company, and you've got a rising tide with the equity asset class behind you. Just may underperform a little bit.
Let's get back into your wheelhouse. Here's Jim in Whitefish, Ontario. Hi, Jim.
Hi, Mark. David, I know you like Ultra Gas has been your favorite pick of yours before, and you do stop losses as well. Would you consider buying a put to protect your downside? The only thing I worry about stop losses, it may go through your stop loss. Thank you.
Yeah, certainly, John. Buying a put is an alternative on something like this. We tend to use stop losses, and I want to make it clear when we use stop losses on our positions, we aren't entering an order and leaving it sitting out there in the ether. We've got a trade desk that thankfully works our way through executing orders as they need to be done. But certainly, using as a put is a viable option. You've just got to find the right price to do it. I would give this a little bit of space. 200-day moving average is down around $41 or $42. There's a nice yield supporting it. You're going to get great dividend growth going forward. So I'd stay with it and either use a put or use a stop loss to make sure you've got a little discipline if it starts to underperform at some point.
So is it almost a daily thing with, say, an AltaGas where you're setting new stop losses underneath it?
So what we do is, say we make an investment in a security that's trading at $20 a share. We're going to identify a price below the price they're currently trading at. We try to identify sort of significantly significant inflection points where the behavior of the security is changing, because we want to see behavior support our view. So every security has a different personality, different level of volatility. And then what we'll do is we'll ratchet the stop losses up and behind. So we reset our stops daily. And if there's an opportunity to raise the stop, we'll raise it. We'll never move it lower.
Mm-hmm. Okay, David, next up is John. He's in Toronto. Good evening, sir.
Good evening. I'd like to your guess long-term view of Capital Power Corp.
Great. So, John, clearly one of the big themes in this market is people are looking for income replacement. I'd encourage everybody to look back at what happened in the 1950s and 60s after the Second World War. Interest rates stayed between 2% and 3% for 15 years. And during that period of time, anything that paid a dividend was slowly revalued versus the rest of the market because people couldn't get a return in fixed income. And people talk about dividend stocks as being relatively expensive today relative to the last 7 or 8 years. Of course, nobody was looking for a dividend 7 or 8 years ago. In the 50s and 60s, by the time the Nifty 50 had run its course, those companies were trading at 40, 50, 60 times earnings and were paying 70% of their earnings out. So the S&P is paying out about 33% of earnings today, way below the 50% long-term average, and certainly trading in high teens multiples. So Capital Power, I would say, plays into that demand for income replacement. You're not going to get a lot of growth. This is a very slow growth company, but you're going to get paid a pretty good yield. Yield's close to 5%. So if you got a little bit of dividend growth along the way, plus your 5%, you're going to do okay. Now, if we wind up with a rip-roaring economy, which I don't expect, this may underperform a little. But as a fixed income replacement, pretty attractive. And good long life assets, very predictable. We are shareholders. We own it in a couple of our balanced mandates. And not a big company, but $2 billion market cap, but I'd buy the stock.
Okay, thanks for that, John. Next up is Monica, who's in Vancouver. Hi, Monica.
Hi, thanks for the call. My question is in regards to Whitecap Resources. I'm just wondering what you think of it. It seems like the PE ratio, but it's got a lot of people are following it right now, and I'm just wondering if you keep the point and if you like the company. Thank you.
Thanks, Monica. I think I heard her mention PE ratio. You want to look at price to cash flow, don't you?
Yeah, you'd want to look at a cash flow multiple on something like Whitecap. You're buying Whitecap for a couple of reasons. You're buying it because they've got a very low finding cost. They've been very good at growing their production and reserves. We have purchased the oil and gas producers specifically because of volume growth, not because of high price of oil. Having said that, really in the last couple of days, technically, oil has cleared a pretty significant hurdle at $104, $105 and points to higher numbers. So I think there's a lot of views that these energy companies are more expensive. I think, there's two things that go into saying whether a stock's expensive or not. One is price and the other is the earnings estimate. And if cash flow estimates are too low, then it may not be as expensive as you think. So we think Whitecap's attractive, and I think you get some dividend growth in this one, and there's nice yield attached. So I'd be there.
Okay, there you go, Monica. Thanks very much. More questions for David right after this break.